So for this mock exercise, we're going to do transactions, recording transactions, property, plant, and equipment transactions for a company called Cadlick, Inc. So let's take a look at this question. So if I look at the required, it's asking us to record a transaction. So that's the first part we need to do. So we need to do some journal entries. And then the second part is determine the cost of the land improvement, and building that's going to appear on the financials of the Cadlick's balance sheet. So let's look at the first transaction. So in 2009, Cadlick incurred the following transaction related to the purchase of the property. And these transactions assume cash was paid unless otherwise stated. So on January 22nd, the beginning of the year, the company purchased real estate for a future planned site for $220,000, paying $55,000 cash, and signing a note payable for the balance. Now, there was an old building on the site. This is the fair value of the land and building were $170,000 and $50,000 respectively. So if I read this, it says they bought a real estate, both land and building. There's an old building on the site for future plant. So there's an intent that the company really purchased the real estate for its land value. So if there's an intent that the old building is not going to be used for this future plant site, then the entry for January 22nd is we're going to debit land for the entire cost, and we're going to credit cash for the amount paid, and the remaining difference is notes payable. So the important concept here is, even though the company bought land and building, and there's an old building in the site, Cadlick's intent is they paid $220,000 really not for the value of the old building. It's really for the land value. So there is a requirement to include the land, the building, and the purchase of the land and building as part of land. Now on the 24th, we paid $4,500 legal fees for the real estate purchased. And again, the question is that an expense or is that part of the asset? And the answer is we need to include it as part of the asset because it was necessary to get the ownership in place, the legal cost. So we're going to debit land and credit cash for $4,500. Now on the 31st, we paid $25,000 to demolish the old building to make room for the new plant. So if the 22nd entry still confuses you a little bit and saying, given the fact that we're given fair value of the land and building, should we not have recorded the fair value of the land and building instead of just recording everything to land? This journal entry on the 31st, the fact that we're demolishing the old building means that that value of $220,000 was really paid not for the building, because Cadlick places zero value of the building. It's really all for land. Now, what do we do with this demolition cost? Well, clearly we can't include it in the building because there's no more building. So we're going to include it as part of the cost of the land. Why? Because we need to, any cost associated with getting the land ready for its intended use, which is to build a future plant site, all goes to as part of cost of the land. So we're going to debit land and credit cash for that demolition cost of $25,000. Now, it's imperative that we record it as land because, as you know, land is not depreciable asset. So it's not going to affect any future expenses in the form of depreciation if we put it all to land. Now, on February 13th, we graded and filled the land at a cost of $8,000 in preparation for the construction. So this is a really interesting transaction because the question is the $8,000 grading and filling the land, is that because the land needed to be ready to be built on, or is that part of the cost of erecting the building, cost of constructing the building? So you have to kind of decide what to do. So we're going to assume on February 13th that the grading and filling of the land is an important process of building the building. In other words, the land itself didn't need to be graded if we were just buying land for speculative purposes. Then the land, right? We didn't need to do that, but the fact that we needed to grade and fill the land ready to build the building, we need to include that cost as part of the building. So we're going to assume that's the case. So we're going to debit building, $8,000, and credit cash, $8,000. Now, on February 28th, we received $7,500 for residual materials for the demolition of the building. So basically, we tore down the old building and we received $8,000 or $7,500, sorry, as cash for some of those materials from the demolished building. The question is, what do we do with that? So we have two choices. It's either going to be recorded as revenue, okay? So we know that on February 28th we received cash. So we're going to debit cash. We're either going to credit revenue, okay? But given the fact that that's not really what we do, that's not what CalDEC does, it's a transaction. It's really more of an incidental transaction associated with erecting a new building. Then our standard requires us to credit building. In this case, we would credit land in this case because it was getting the ready. Remember, we tore down that old building to get the land ready for its intended use. And if we have salvaged some of that material, it really helps us offset the cost of the land. So that should be credited to the land value. Now on March 14th, it says paid $3,400 for architect fees. So we can probably agree that that goes to part of the building, not to the land. Because again, the architect, the drawings are from the architect. It's important to make sure that we build a building that's up to code and a building that's going to be useful to what the company needs. Now, on March 14th, on March 31st, we paid local municipality $5,000 for building permit and $10,000 for the 2009 property taxes. Again, were these costs necessary to get the building up useful? The answer is yes. The building permit definitely is an important part of erecting a new building, and the property taxes during construction can be capitalized to the cost of the building. So we're going to add $15,000 to the cost of the building, which is the sum of those two amounts. On April 22nd, what happened? It says excavation costs of the new building were $17,000. Again, you can probably all agree that that should be part of the cost of the building. On June 15th, We received a bill from the contractor for half of the cost of the building. We paid them $300,000. So we definitely need to record a debit to the building because it's part of the construction cost. Now we paid $7,500 cash, $75,000, sorry, cash, and the rest is a notes payable. On September 14th, we received the bill for the remaining $300,000, which is the second half of the construction cost. And this time we paid $100,000 and we signed a notes payable for $200,000. So again, we're going to debit building, credit cash, and credit notes payable. Now, on October 12th, what happened is we paved the parking lot for the driveway and sidewalk. So parking lot, the paving of the parking lot and driveway and putting a sidewalk, those costs, although it is part of land, the value, the economic benefit diminishes over time. So it's important for us to create another account because remember, land we can't depreciate. It's one of those assets that we don't depreciate. But these land enhancements that we do, like parking lot, driveways, and sidewalks, the benefit doesn't last forever. So we need to create another account called debit land improvement. And this is an asset that is amortizable, and it's not part of land. Because remember, driveways and sidewalks have to be redone after a certain point in time. So that's why those costs have to be segregated from land. And we install the fence, and again, the fence is land improvement. Okay, so those are the transactions for CalDEC. Now, Part B says what are the amounts recorded for land improvement and building on December 31st, 2009 balance sheet. So for Part B, it's just a matter of looking at all our journal entries. So we've got building here, land, and land improvement. So we know that on January 22nd, we bought the real estate. And we know that, so this is, so this is over here, sorry. We know that the real estate, what we paid for really was a combination of, there was land and there was building on that land, but the intent was we were going to demolish the old building. So chances are what we paid for was all for land, and we placed zero value to the building. On the 24th, what happened was we added legal fees to the purchase, so that should be part of land. On the 31st, if you remember, we paid $25,000 to demolish the old building. And again, we need to record all related costs associated with getting the land, getting the land up to its intended use. And we need to clear the old building for us to start building on the land, so that demolition costs should be part of land. On February 13th, what happened, if you remember, the journal entry was we graded and filled the land. And again, we're going to assume that the grading of it was to do with the building. Okay? So the fact that the land was already ready, was already as is, we didn't need to do anything about it, then to me, it's really not part of the cost. And this is part of getting the building, start to build the building. So that's really part of the cost of the building. On the 28th, We received $7,500 for the residual value of demolishing the building. Now, the fact that we demolished the building, because that was part of getting the land ready for intended use, that's really to help us reduce or recover some of the cost of the land. So that should be offset against the cost of the land. Now, on March 14th, we paid $3,400 for architect fees. So now we're starting to build the building, so it should be part of the cost of the building. And on the 31st, we paid for taxes and what have you. So those, again, are part of the constructing of the building. So both the municipal taxes and building permits and property taxes should be part of the construction period. April 22nd, excavation cost of the new building of $17,000 should be also part of the new cost of the building. And on June 15th, remember that was the first $300,000 cost of the half of the construction, and we also paid the second half on the 14th. Now, in October 12th and 20th, we erected fence and driveways and what have you. Those are land improvements. So if you think about it, we've already really, when we bought the real estate, we tore out the old building. We paid the legal fees associated with the actual purchase of the real estate. We tore out the old building, and we actually got some revenues from some of the salvage material. Those are part of the cost of getting the land ready to be built. Any cost associated with erecting the building should be part of the building. And again, the difference here is that land is non-amortizable, but buildings and land improvements are. And anything we do to the land that does not add a fixed, indefinite value, so things like parking lots and fences, the benefit, usefulness of those assets diminishes over time. So sometimes you'll have to replace or you have to repave the parking lot. Sometimes the fence have to be repaired, etc. Those are part of what we call land improvements. And of course, they have to be amortized. So we need to add for the building, we've got $674,000. For the land, it's $242,000. And for the land improvement, it's $50,000. So that is what's going to be reflected on the books of Caldic. Thank you.